the 2-year Treasury bond is actually 0.73 higher than the 10-year. So it's still an inverted yield curve. And I think until we see that change, it's going to be very difficult for investors to start to get excited. That's probably not going to change until one of two things happen. We get so much more inflation that it drives up long-term bonds so that they're finally higher than short-term bonds. But if short-term bonds are 5%, that means we'd have to see long-term bonds go up to 5.5% or 6% or even more. Imagine what that would do to the economy, and imagine how hot the economy would have to be, how strong inflation would have to be for that to happen. Or we go into a recession and the Fed starts to cut rates, so maybe long-term rates go down a little bit, but the Fed brings down the 5% rates in short-term treasuries all the way back down to, let's say, 2 or 3%. That's why this is such a tough market to read, so tough to get a gauge for any direction, because investors are just so darn confused. And the case for an up market, strong economy, down market, down economy, the case for both are very, very compelling.